Hi, this is Nilus Mattive from Money and Markets TV. This week, I want to tell you about a strategy that I've been recommending to subscribers of my Income Superstars newsletter called cover call writing. It does involve options trading, but it's still conservative and easy to implement. First, a brief word on options. They're contracts that allow investors to buy or sell a given security using calls or puts, respectively. The call or put is set at a given price, known as the strike price, over a specified time frame. Each options contract covers 100 shares of the security, known as a round lot. Investors frequently use options as a way to hedge their portfolios or to speculate on a security's future moves. One advantage of using options is that you put less capital at risk, because buying a contract allows you to control 100 shares for a lot less money than buying the shares outright. Plus, you have strictly limited downside, which is not technically the case with other speculative activities like short selling. Covered call writing carries even less risk than the usual options trades. That's because rather than trading these insurance contracts, you're selling them to someone else and collecting the premium, the price that the investor is willing to pay for the option. The reason it's called covered call writing is because you are only writing calls on stocks you own. If you create and sell a call for a stock you don't own, it's known as naked writing, because it leaves you exposed to lots and lots of risk. Needless to say, I don't recommend naked call writing. Since options contracts always involve 100 share lots, you'll need to own 100 shares of a given stock to write a covered call. If there's an active market trading options on the shares, and your brokerage account is set up to write options, you're ready to start. First, you have to decide what kind of contract you want to write. It should be a contract that's out of the money, meaning the strike price you're selling it for is higher than the underlying stock's current value, or at least higher than the price you paid for the shares. For example, if you own 100 shares of a stock you bought for $30, you may decide to write a contract that expires in September with a strike price of $35. Let's say that contract sells for $1.50. Because it covers 100 shares, you'll collect a premium of $150, and you'll get that premium no matter what happens next. If the stock price fails to rise above the strike price of the contract, the investor who bought your call option will let it expire worthless. You get to keep your stake in the company, plus the money you collected for the option. End of story. The same is true if the stock goes nowhere or down during the life of the contract. And it's even true if the stock temporarily goes above the strike price, but the investor holding your option fails to exercise it. Also, once the option expires, you're free to write a new call with a new strike price and a new time frame, which would allow you to continue collecting more and more premiums in the process. But what happens if the stock rises above the strike price and the investor exercises the option before it expires? Well, in that case, you're forced to sell your shares to the options holder at the strike price. This is your only obligation. You can never be forced to sell the shares at any price other than the strike price. In other words, the worst thing that can happen with covered call writing is that you're forced to part with your shares for a predetermined price. Think about what that means. Essentially, you've made money from the sale of the option, from any dividends paid along the way, and from the exercise of the option itself. And you can always buy the stock back later if you want to. In short, this is a great approach to use to get more income right now, especially given the recent slowing momentum in the stock market. I'm Nilus Mattive from Money and Markets TV. Thanks for watching.